So here it is, Tuesday. We've had a day to digest what the markets had to say about the S&P downgrade this past Monday, and we can see that the S&P got it wrong, right? Spectacularly, they got it wrong, right? And so, and one of the reasons why they got it wrong is obvious. It's obvious. Our debt has nothing to do directly with entitlement spending, right? Social Security, Medicaid, and Medicare, the benefits thereof, the payouts, are not financed by our debt. Never have been. And so, again, I'm at a loss as to why David Beers would say that. That's number one. Number two, stock markets around the world are tanking, right? On the realization that Germany once again has to bail out another Euro nation. Uh, Last year it was Greece. This past couple of months it's been Italy, and now it looks like it's going to be Spain. So where do investors turn when things go sour in the stock market? They turn to U.S. Treasury bills and U.S. Treasury bonds. And in a minute, I'm going to show you the actual yields from the Treasury.gov site. So here I'm at the Treasury.gov site, daily Treasury yield curve rate page. I went ahead and pulled for the current month, and you can see here we have the columns represent the term structure. So 1 month, 3 month, 6 month, 1 year, all the way up to 30-year Treasury bonds, and the yield rates between the post S&P pronouncement and the pre S&P announcement. You can see that for the 1 month, 3 month, and 6 month, that the yields are a little bit higher, right? The yields are just a tad bit higher. We're looking at a couple of points. But as for the long-term structured U.S. Treasury bonds, you can see that the yields, for the most part, are significantly lower. So once again, what I'm saying to you, what I'm trying to convey to you guys is that the S&P got it wrong. Spectacularly, they got it wrong, point blank. So now, since we know the S&P got it wrong, you got to ask yourself a couple of questions. Why is it that the S&P noted that the entitlement spending is the biggest factor in its opinion, its latest opinion of downgrading U.S. sovereign debt? Again, that makes no sense to me. Entitlement spending is a contingent liability, right? And it would be footnoted on the balance sheet if this were a private corporation. That's number one. Number two, why is it trying to affect fiscal policy making decisions? That's not its job. Its job is to rate debt and not to place an opinion on the internal workings of a company. In this case, the United States federal government, or Congress specifically. So, and what baffles me about the S&P, I could name you many occasions in which the S&P had gotten it wrong. And if I could short S&P ratings in the stock market, I would be a freaking millionaire. So that being said, I wish good luck to you. Okay, peace to you all.